Welcome to this edition of Taking Stock for the week ending the 15th of November 2024. I'm Kien, Trinh, Head of Research at Stock Doctor, and joining me today is our Senior Equities Analyst, Jason Yin, to stream to you all things share markets. Welcome, Jace.
Thanks, Kien. Thanks for having me.
It's a pleasure, Jace, and this month has certainly been very busy for us with the bank reporting season, AGM updates, the Trump trade, and also mining stock volatility. But we'll touch on that a bit later. But before we get started, just a quick yet important reminder that the information we provide today is of a generic nature and therefore shouldn't be taken as personal advice. Remember, shares are volatile, so past performance figures shouldn't be relied upon as a guide for future performance. Also, Jace, I just wanted to say a big thank you to all our platinum members who were able to attend our exclusive dinner events in Melbourne and also the lunch in Sydney this week. It was a very insightful session and appreciated everyone for sharing their stories, ideas, and I hope we all were able to resolve all your curiosities during the session. We still have limited spots available, so if you are interested in joining Platinum, feel free to contact Michael Mercury on 1300 676 333. Now, Jace, let's kick things off with the big story this week, the volatility across the Australian mining stocks. Chinese governments, their latest fiscal package aimed at supporting local governments fell short of market expectations. And this led to declines in the key commodities, especially iron ore, affecting stocks like Australian Miners, BHP, and Rio Tinto.
That's right, Kien. And also adding to this uncertainty is the speculation that higher tariffs on Chinese exports under President-elect Donald Trump's administration could be ushered in. I mean, the prospect of increased trade tensions has obviously risen concerns about the demand for Australian resources. And given China's significant trading role with Australia, this has become a pretty pertinent topic. The geopolitical development has also contributed to the volatility, as you said earlier, in the mining sector as well, Kian.
Indeed, Jace. And beyond the macroeconomics, though, our lithium miners, they continue to be weighed down by negative news flow and also weak lithium prices. Early in the week, Mineral Resources announced that they had to halt their operations at their Bald Hill mine in Western Australia, citing high cash costs and also low lithium prices, making the mine operations unprofitable. And together with management uncertainty following governance issues here, we are currently reviewing our stance on Mineral Resources.
Following on that as well, Ken, we've
Mm.
got the perennial topic of, lithium pricing effectively going down, and this has contributed to negative cash flow for both Mineral Resource and also Pilbara Minerals as well, increasing its chances of failing a financial health assessment this year. But shifting our focus to the banking sector, Ken, I mean, there were some number of key themes that stood out to us, especially around dividend sustainability. Can you tell us a little bit more about what you observed this season?
Yeah, Jace, it was quite a tough operating environment for the banks. Most were reporting high single digit declines in their cash earnings, and that was due to increasing operating costs such as wages and expensive technology upgrades. But all in all, credit quality remained strong. And although bad debts were rising, they are still trading around their historical average levels. So it wasn't elevated. More importantly, though, the banks were able to maintain or increase their dividends, and this helps support the positive share price performance over the last couple of weeks.
And we've also noticed that the dividend payout ratio has moved towards the upper band of the bank's target range. And this has allowed a little margin of safety if bad debts start to rise from here on. But the bank dividends are sustainable from our point of view, as long as economic conditions do not experience a hard landing.
Yeah, that's right, Jace. That upper band in terms of their payout ratio, seems a bit extended, but all in all, the banks regarding their outlook, they are cautiously optimistic, expecting economic growth to recover this financial year and into the next. So, providing some support for its earnings outlook, with most banks expected to generate single-digit earnings growth in the coming year. But we'll speak more about the banks at the end of this episode. Let's now turn our attention towards accounting software provider Xero. It's fair to say that they've had a strong result, outperforming guidance, Jace. Wouldn't you agree?
Yeah, the company sort of went from zero to hero at one
Mm.
stage there, Ken. The company's performance did, in fact, exceed expectations, and that was on multiple fronts. So they delivered a pretty strong profitability with both gross margins expanding and also corporate expenses declining as well, which was more than the market had anticipated. And this should support the company's return on equity ratios. And it's also a testament to management's strategic execution as well.
Yeah, Jace, not to mention their profit margins as well. Xero's ability to effectively cross-sell into their adjacent products and leverage their dominant market position to implement price increases has been a key driver behind these results.
Yeah, spot on, Kien. However, the company did opt not to provide specific guidance this time around. So the focus will undoubtedly on how efficient the company can sustain its cost discipline moving forward. This will also feed into the outlook numbers as well, with the market anticipating strong earnings and also strong revenue growth for the next 2 years.
Yeah, incredible numbers there, Jason. And another critical factor for investors will be the company's ability to maintain its pricing power. So that's flowing through into the margins. Although Xero has successfully increased their prices, there was a slight dip in net subscriber growth during the first half of financial year 25. So we'll be watching this situation quite closely.
And also looking ahead for next week's corporate calendar, we've got billing software provider Technology One expected to report its full year results. And there'll also be several Star Stock AGMs taking place as well. So please refer to the calendar within Stock Doctor for full details.
And for this week's Under the Microscope segment, we're focusing on Aristocrat Leisure, a global leader in gaming technology, renowned for its gaming machines and those pokies and digital gaming content. Aristocrat has established a robust presence across both land based and also online platforms. The share price ran up hard into the result, and it appears that Aristocrat met the market's high expectations, Jace.
Yeah, that's certainly right, Ken. The company reported a pretty strong performance for FY24, and this was primarily driven by the North American gaming division, which saw significant expansion, as well as positive contribution from the Pixel United segment as well, which is their digital gaming arm, and that benefited from lower user acquisition costs.
Yeah, quite an impressive result, Jace. Management did also forecast further earnings growth into financial year 25, and they did reaffirm their target of achieving 1 billion US sales revenue for Aristocrat Interactive by financial year 29. So a few more years there down the track. This should support their positive earnings revisions. And regarding installations, North American Gaming added around 7,100 net new gaming machine installs, surpassing their guidance as well, though they did anticipate a slowdown in the next couple of years. What's behind this?
Yeah, that's right, Ken. And I guess just first and foremost, when we mentioned installed units in the context of aristocrats, we're primarily referring to gaming machines that are placed within casinos and gaming halls and other venues. These units generate recurring revenue for the company, typically through a revenue sharing model or leasing agreements rather than outright sales. So the anticipated slowdown in new installs reflects potentially a shift in strategy. I mean, with market penetration already very high, Aristocrat's probably focusing more on optimizing its existing install base footprint rather than chasing aggressive expansion. And this sort of makes sense, especially, some of the economic headwinds that some main casinos could potentially face as they prioritize upgrades over new purchases.
Yeah, it appears to be a smart pivot, Jace, focusing on profitability over volume. And this should help maintain its strong profit margins and return on equity, Jace. Aristocrat also recently announced the sale of its Plarium mobile gaming unit. How does this fit into the broader strategy?
Yeah, it's a good question. I mean, the Plarium sale aligns with management's focus on core strengths in gaming machines and also in regulated digital markets. The proceeds would obviously help reduce debt, Kien, and potentially improve its financial health rating, and also as well support any growth initiatives such as expanding further into the iLottery space as well.
And the share price has done exceptionally well for investors,
Hmm.
perhaps also driven by the Trump trade with its exposure to those US markets. But despite this, the share price does appear to be trading in line with consensus price targets. What should investors be doing?
Well, if you have an overweight exposure, then the prudent thing to do would potentially consider taking some
Mm.
profits off the table. But if the strategy shift is positive and there is extended growth profile moving ahead, then investors should potentially watch for any hiccups such as subscriber growth or any new content rollouts and then base their decision on that. I mean, the growth runway still remains pretty strong for Aristocrat, and in our view, it still remains a pretty quality growth company.
And following the bank reporting season, a question that is often asked among our members is which bank performed the best over that reporting season?
It's a question we do indeed get a lot of the times, Kien,
Mm.
and members can compare the bank metrics by referring to the income view under the watch lists and also selecting star income stocks and then sorting by the gigs classification. Alternatively, they can build their own filters by selecting the bank gigs, star stocks, and then ensuring they include any key metrics such as return on equity, forecast dividend growth, forecast gross dividend yield, dividend payout ratio, 3-month EPS, price to consensus price target, forecast PE, and also the 1 year total return.
Yeah, and looking at some of those key metrics across our majors, we can see that Westpac has achieved the strongest return over the year. It also has the largest positive earnings revisions over the past 3 months as well. So, not surprising there, indicating that it was potentially the best performer, beating analyst expectations over the reporting period.
Well, some of these expectations are sort of centered around the fact that it had a $1 billion buyback extension as well, Ken, and its optimistic outlook and also its increasing dividend profile also supported that view as well. In addition, the bank is planning to accelerate its technology simplification program under new leadership Peter King, and Westpac continues to have the highest gross dividend yield across the majors at around 6.8%, which is very appealing to many income investors.
Yeah, definitely, Jason. Meanwhile, though, despite having the lowest forecast dividend yield at around 4.4%, Commonwealth Bank has performed well over the bank reporting season, and it has the highest return on equity among its peers, a more efficient cost base, and also the highest credit quality amongst the majors as well. So the bank performed quite well over that period.
Yeah, it certainly has, Ken. Its share price is also shooting way up north as well, Ken, which
Mm.
we're happy to see. On the other hand of the equation, we've got NAB, which came third, and the bank benefited from its exposure to business banking. Under the guidance of its new CEO, Andrew, the bank plans to accelerate its investment spend into FY25 as it focuses on selling high proportion of its home loans via its own channels rather than through mortgage brokers as well. And this will allow it to improve its profit margins, which is also pretty good outcome as well. However, the business loan growth is expected to slow, and this could contribute to lower than average share price performance over the potentially near term.
Yeah, a lot of these banks seem to be investing in their technology at the moment, and
Mm.
but our least preferred one has been ANZ Bank, and this was reflected in its performance over the reporting period. It had the lowest return on equity among the majors, with earnings growth also expected to fall behind the other banks. In fact, unlike its peers, dividend growth is forecast to be flat in financial year 25, driven by this uncertainty with the integration of the Suncorp Bank acquisition and also the technology migration, which could lead to higher than expected costs as well. In addition, you've got its dividend. It's only 70% franked, making it less attractive to income investors.
Yeah, it's a good point, Keen. And from
Mm.
a valuation perspective, all the banks are trading at a premium to consensus price targets, and this is potentially driven by external factors such as the Trump trade, expectations for an economic soft landing, and also the rise of ETFs as well. So, depending on your investment objectives and considering tax gains and also capital implications, prudent profit taking may be warranted.
Yeah, and so to summarize, Jace, Westpac was the best performer, followed closely by CBA, although the valuation of CBA does leave a lot to be desired there.
Mm.
Prudent profit taking is recommended to ensure you manage concentration risks. That's all we have time for today. And again, thanks for coming on and sharing your insights.
No, thanks, Ken. Thanks for having me. And I feel like we've covered a lot of details today as well. If you have any follow-up questions, feel free to attend our Lincoln Live webinar every Monday.
Yeah, of course. And in the meantime, Have a happy, healthy, and prosperous week ahead, everyone. See you next time.